Welcome back to another episode of the M&A Guy. I'm your host, Brian Franco, and we're here to dissect the world of the private capital markets. Today, I have a special guest who I've had here before, Mr. Mick with Mode. Mode what? Remind me again.
Yeah, Mode Growth Partners.
Mode Growth, but remind me of the story.
Yeah. So Mode was originally a combination of two last names, Morgan and Denner, yes. M-O and D-E.
Yes. This is your wife's maiden name.
No, it was buddy mine. Yeah.
Oh, buddy
yours. Yeah. We were going to do this together.
Yes.
Things didn't work out with him.
Yes.
So it was just
you carried
me.
The baton.
Yeah.
Awesome.
But then Mode kind of evolved into, if you think of Mode in the data set, like the mathematical term.
Correct.
A mode is the number, probably not the highest, not the lowest, but it's the one that shows up the most. Yeah. So I think it's a good attribute that I have. I'm not going to be the biggest, fastest, strongest, smartest dude, but I'm going to show up the most and work the hardest.
Well, Mick, thanks for being here. And those listening in, so Mode in Mick's group is classified as an independent sponsor. So what they do is they go out into the market, they locate and find a business to acquire, grow, and eventually exit. But the idea is to grow it as if it was going to grow in perpetuity. And we've had the opportunity to work together over the last couple of years. Like I said, you were a guest on the podcast before. So what do you want the world to know? Because there's founders, there's owners, entrepreneurs that are learning about how they can sell their companies. Yeah. And there's all these flavors of capital that I always talk about. But tell us about your flavor.
I guess just there are, I don't want to say unlimited, but there are so many opportunities to partner with the next chapter for the business, right? You've got your strategic buyers who are in your space already. Yeah. You've got traditional private equity firms who might want to put you in a portfolio. But then there are other folks like me, independent sponsors, search funders, entrepreneurs who are just hungry to take over an exciting, growing business and kind of shepherd it into the next generation. And so, yeah, I really just want to be here to talk more about those alternative exit opportunities that can yield some pretty incredible results and be a great avenue for continuing someone's legacy.
And they're even teaching now in universities ETA, which is entrepreneurship through acquisition. And so the idea and the concept is to teach these students in school, startups mostly fail, majority of them. That's risky. Yeah. Where, existing companies that have been in operation for 10, 15, up to 40 years, right? Could be generational. And they've run the company a certain way. And now we're here in 2025. The world's changed. Labor is different. Technology is different. Right? How the world works, even lending is different. And so you are faced with this opportunity when let's call them baby boomers. I'll pick on them for a bit because they actually represent the largest wealth transfer at the moment. Right. The amount estimated $10 trillion of assets that boomers own in the U.S. And so these assets need to change generational hands, or they need to be sold. Could be real estate in the context of what we're talking about is business. When you think of the demographic of the baby boomers and the different types of companies at different levels and industries, what would you say the ideal, and I have my opinion on this, but what is your approach in terms of how you differentiate yourself from the private equity groups of the world and from the strategic buyers, whether they're public or privately owned?
Very great question. I mean, to your point, there is this massive group of baby boomers, Gen Xers who have built incredible businesses. They may or may not have a firm succession plan in place. Again, there are several avenues where they can, sell their businesses, move on to the next generation. I've kind of positioned myself as being that son that they don't have, that wants to take over the business, right? To kind of continue the family feel of the business, continue kind of the more local community first nature of the business. And I think that's a huge benefit of the search fund, independent sponsor type model, whereas it's just one entrepreneur who's coming into the business. Now, we're also bringing a lot of capital. We're bringing, for example, I have equity investors who have hundreds, if not thousands of deals under their belts. They've got capital to fuel growth, let the owner take some chips off the table. You can get that obviously from a strategic or a private equity firm, but if you're really looking for someone to shepherd the business, continue its trajectory of being a community first, family first type model, that's where I sort of fit into the equation.
So it's culture, it's stage of the business, because some of these companies where my perspective as a traditional equity group is going to look for an org chart that's continuous with the company. Their ownership in a situation like that is typically independent of the org chart, mostly. Right. So you have a CEO in place, you have a CFO in place, but where the opportunities in which you're exploring, they don't have that org chart necessarily, or they have the titles, but not the true organizational structure and the SOPs that go along with that sort of structure. So my perspective, our experience at Meritage is we find that there are certain clients that aren't ready for, let's call it, the major leagues, right? They're still professionals in their own field, but they're not the major league level, and I'll say the minor league level, but that's the opportunity for them, and that's the opportunity for you, because your experience is helping them get to the major leagues. And the beauty there is that they could do that with less risk, with less headache, with less heartache, because you're coming in with a certain set of processes and procedures and experience to bring the company to that level, right? I mean, don't you agree?
No, exactly.
Yeah.
I think that's, again, a benefit of one person coming in who would ideally replace a founder, CEO, someone who's in the trenches, in the books every day, and has kind of reached a point in their career where, I love this business. I would love to see it keep growing, but I don't want to do the day-to-day stuff anymore. Maybe I want to take a step back and just focus on sales or just focus on one element of the business and have someone else run the overall operations.
Correct.
And, to your point, a lot of us, my peers in this sort of same model, bring some very actionable experience.
Correct.
So I was a Marine officer before business school, served right down the road here in Pendleton. And then after business school, worked for Danaher, which is a huge Fortune 500 company, owned P&L at about $13 million, and then was essentially chief of staff for a $400 million P&L globally. Companies get that big by, to your point, putting in playbooks, SOPs, best practices, and all of those, fancy things that people think of at these huge blue chip companies are easily applicable to small businesses as well. And really, that's what I see as kind of the key to growth.
For those listening, I think this is a good question or a good answer for them to hear from you, but what comes first? The capital or systems and processes in an organization?
Okay, so I'll get the classic, it depends. I mean, if the business has no processes or no SOPs, we're still writing down customer orders on a yellow legal pad.
Correct.
Then probably let's introduce some basic software. Let's introduce some SOPs. But if a company on the flip side has introduced this technology, they've introduced several SOPs, but they're just stuck. They don't have the funding to bring on more marketers or more sellers. They don't have the capital to expand geographically. That's when the capital would come first. But again, a benefit of a model like independent sponsors or search funders is generally they can inject both. They can inject some capital onto the balance sheet. They can bring SOPs and playbooks with them as well to inject into the business. So, both could come at the same time.
Yeah, I mean, my perspective is there's kind of three routes, right? A seller client is not ready. Or they're ready for the minor leagues, or they're ready for the major leagues, right? And so with those three classifications of where they are on their journey, those that are not ready because they can't access the capital. And we teach them that, and we have processes and workshops to teach them this, but that has to be in place to access the capital. And I'm speaking more in the form of debt.
Sure.
Right. And so, but once they could get to that stage and to that level, that debt or that capital that they're renting, so to speak, is helping them fuel the growth of their business. But it's a machine, right? That machine has to prove to produce more money than you input into it.
Sure. Yeah.
And if it doesn't, that's a loss, right? With that illustration. So that's why I really appreciate what independent sponsors do. And recent statistic, I don't know if you're aware of this, is independent sponsors outpaced private equity last year in closed transactions.
Interesting.
And I think that's really because there's a lot of business owners and stakeholders are at a place where, yes, these companies need to transfer due to, generational transfers, or a lot of business owners that we see, their business deteriorates with their health. And we have a case study right now where the gentleman realistically should have sold the company 20 years ago. He's in his 80s. And, it's tough. It's tough because he does have an org chart. He does have people, but he was the breadwinner. He was the rainmaker of the organization. He has and had the relationships, still does. But when you think about that case study, he had everything, but he had not removed himself from being the only rainmaker of the organizations. As his health deteriorates with age, like mine will one day, right? So does the business. And
Sure.
you could almost see a correlation between human health and the P&L of the company.
Fascinating.
And so, but if you can come in and at the right time, maybe even forget 20 years ago, let's even 10 years ago would have been much better.
Sure.
There's still an opportunity to come in and activate a sales force and turn that business on and give it the ability to grow at the scale it was historically.
Right.
And they actually did a lot of work with the Air Force in their, because the Air Force has their own hospitality division. Because we train other countries, right? So they have their own hotels and own golf courses. I mean, as a civilian, I can't access, I'm sure you can. But the reality is other countries pay to come and train with us here in the States. And so that hospitality division of the Air Force is actually not a profit center, but it's not a tax burden on the taxpayer. It's self-sustaining, which is really cool.
Very cool. Yeah.
So they did a lot of the design of that. Again, plenty of work there, plenty of growth opportunity, but if you're one rainmaker in the organization, that's tough. Like, how would you perceive an investment like that?
Yeah, key man risk would
Key
be
man risk.
kind of the definition there, I guess, or the term. It'd be very tough. I think if that owner owns the relationships, not just for sustaining current relationships, but also for growing potential future ones, I would want them to be very involved in the business for several years. And it sounds like in
there's
this
the
case,
punchline. Yeah.
Yeah, right.
Several years could be impossible.
It could be, right. So I think in that case, that level, just based on what you shared, that level of key man risk would probably be too much for at least me and my investor group to get really excited about.
Yeah.
So unfortunately, to your point, I mean, timing plays a key.
Correct.
Yeah.
Correct. So what type of industries have you been looking in, and what's been exciting you in the marketplace, generally speaking?
Yeah. So broad themes, I've looked in healthcare services and industrial services and some kind of niche light manufacturing businesses.
Okay.
Really touches on my military experience. So I was a combat engineer, very technical field, sort of blue collar leadership in nature. So kind of plays well into that industrial services space. Healthcare services. So at Danaher, I was in medical device sales, very plugged in with hospital sales, insurance payers, all of those dynamics. That's been a very interesting market the past several months, especially after the passing of the big, beautiful bill, which I'm sure we can talk more about. And then the niche manufacturing, Danaher at its core is a manufacturing business.
Yeah.
So those lean principles that apply on a manufacturing floor, they've also introduced into leadership and sales processes, marketing processes. So I'm very familiar with that world as well. And here in Southern California, of course, there's no shortage of any of those three industries. So
no, I mean, and you're seeing a massive investment into, let's call it reoccurring maintenance or services, which are blue collar businesses traditionally. We see equity groups and investors looking at escalator companies, elevator companies. They're looking at, obviously, HVAC has been consolidated for years and years. You're seeing various versions of home services, commercial services like landscape services. And these companies are achieving very attractive multipliers in terms of valuations because they have what investors want. They have what you want. And that's predictable revenue stream. And that predictable revenue stream, when it's contracted, right? It's not very different than a software company because like a software company, you have a license that you're selling every month, typically per seat or per user, but that's predictable. And your fall off rate over history of years. But with landscape maintenance, the grasses and trees always grow no matter what the economy does.
Exactly.
Sprinkler systems break.
That's right.
And that maintenance work is becoming a very hot market. Earlier, re-roofing platforms, anything in and around, storm damage, could be water, could be fire, could be hail, all of the above, right? And these are things, you don't necessarily control storms, but they will come.
They will come.
And unfortunately not here in Newport Beach, California.
Right.
I don't think we've had hail here. I don't want to say ever because we've had it, but it's tiny.
Not that I can remember.
It's fun. It's fun.
Yeah.
I think it was 2014 was the year we had snow on the sand.
Oh, no kidding.
2014, yeah. So it was it was heavy rain that turned it was more ice.
Yeah, right.
And so you had this layer of snow on the sand. It was a really cool view. So we actually have a cool picture of like in the ocean hitting the sand, snow-capped sand, and then the snow-capped mountains in the backdrop.
That's pretty.
It was really cool.
That's very cool. Yeah. But I think the beauty of what you touched on with those service businesses with the recurring revenue piece, to your point, yeah, grass still grows, trees still grow, no matter the economy. But guess what? AI can't replace
No.
the guys going out to pressure wash a bridge deck. They can't replace, the robots so far.
Yeah.
You can't replace, someone to come out and fix your air conditioner compressor outside your house. So
true.
those businesses are, I think, even more attractive because of the lack of AI disruption. So on the software side, it's kind of spooky. What could
Correct.
happen there,
Correct.
right?
Yeah.
The AI disruption.
Yeah, yeah, you're right. Because I was at a conference this morning, and it was a construction company, and they do massive developments in long-term care, student housing, high density housing as well. And they're saying how the tradesmen, they're electricians, because they're in such high demand, can earn $250,000 a year, where teachers are starting at a $65,000 base salary per year. Right. So we're going to see, based upon their forecasts, those trades are going to continue to climb in compensation for individuals.
Yeah.
And even if AI does come, even robotics come to electrician, anything that's, from my perspective, anything that's tied to a personal license or a personal liability. Right. Someone has to be responsible. Yeah. If you're going to deploy robots to do electrical work, maybe that's the case one day, but someone has to be responsible for those robots.
Totally.
Right. And this is why we have contractor's license. That's why we have real estate license. That's why we have insurance license.
Yep.
Someone has to be responsible. And arguably, we're pretty far advanced in technology when it comes to writing insurance policies. Yes, there's still a human involved, but it's a lot easier now.
Totally. Or even writing code. I mean, why Amazon, all these big tech companies are laying off thousands of employees.
You see Salesforce?
No.
They laid off 4,000.
There we go. Yeah.
4,000 programmers. They just said they don't need it.
When you've got AI that can do the same job, I mean, that's a risk in that area.
Correct.
So yeah. Fortunately, I'm not a software tech guy, so I've always been more kind of, roll up the sleeves, get dirty boots kind of person. That's what my interest has always been. So fortunately, those are the businesses I'm focusing more on.
I want to get to kind of a punchline and takeaway here, because there's a lot of companies listening and they want to know, how do we get your attention, Mick? And when we do, what should we have ready? What should our company look like? So, because getting your attention is one thing.
Sure.
Keeping your attention is the most important thing.
Yeah.
Right?
Yeah.
So what would you say to them?
I think generally kind of the big ticket items a buyer would look for in a healthy, profitable, attractive company would be things. First off, are you profitable? And in this range, that could be anywhere from 700,000 either seller's discretionary earnings, EBITDA, what cash flow metrics.
Adjusted EBITDA.
Adjusted EBITDA, $1 million plus, great. 2 million plus, even better. So I think that the further you go up, the more attractive the business is going to be. What's your growth looked like? Has it been a good, steady, progressive 5 to 10% growth? Is it cyclical in nature? Would probably reduce the attractiveness. But to your point, hey, we've got trees that need to be trimmed. We've got bridges that need to be washed. That has to happen every so often. That's very attractive. For me, I really like regulatory bent to companies. I think a lot of buyers try to stray away from California because we've got very nuanced, I'll put it nicely, nuanced ways of doing business. I appreciate that. I think if you can get into a company that's established and has the licenses, the certifications to do the type of work.
That's right.
Good. I'm all about that.
Yeah, we looked at a deal together, and they were the largest underground contractor for the California prison system, right?
Right.
And we don't think about this, right? But in a situation like that, it's not just boots on the ground doing construction work. You're talking mounds and mounds of paperwork to get clearance to enter in the gates of a prison facility.
Exactly.
Right?
Yeah.
But work has to be done there. Maintenance has to be done there. Someone has to do it. And you have to have the appropriate licenses, appropriate clearance. So, but you look at those types of opportunities out there, there are plenty. And a lot of growing companies. So that's great advice because we echo the same as you, right? Have your financial house in order, be due diligence ready. That's from all aspects of due diligence: legal, financial, operational, HR, I think I said legal already, insurance, so on and so forth.
Yeah.
And now we even have, you look at cyber. That's a big part of due diligence now. It wasn't 10, 15 years ago.
Right.
Right. So great parting advice. Thank you for being on the episode again,
Of course.
or the M&A podcast again,
Yeah.
and I always invite you back. We got to really get together and share the success as you continue to drive the process forward out of that, because I know you're working on some really amazing opportunities. I wish you the best success on all of those.
Awesome. Thanks for having me back, Brian. Appreciate it.
Thanks for being here. And thank you for tuning in to this episode of the M&A Guy. I'm your host, Brian Franco. If you want to learn about how we can work together, we have a very special tool that we built. It's called applebytes.ai. It's designed to measure both financial and non-financial aspects of your company. And it'll tell you if you're ready to speak to the Mick Denners of the world. So tune in for next week's episode. Until then, I'm Brian Franco. Keep on building.